Hey, accounting scholars, welcome to the last chapter of college accounting. Here again, this is going to be a short chapter where there's a couple important concepts regarding depreciation and some related areas that you need to be aware of, and we will cover those expeditiously. So let's get started. Similar to the other chapters, there's a couple things that you need to remember regarding long-term assets. And specifically, they relate to initial cost, which is to make sure that you record an asset at its initial cost. The second is carrying value. Make sure you report the asset at its current carrying value. And the third is to make sure you recognize any gains or losses when the assets are discarded or exchanged or sold. So make sure that you keep those three things in mind with regard to long-term assets. Okay. Let's talk a little bit about what is the cost of property, plant, and equipment. The first thing with regard to property, plant, and equipment is that it is recorded at the total amount or cost required to obtain and get the asset ready for use. And so what does that mean? Well, typically that involves a couple things. The first is the actual purchase price that you paid for that particular long-term asset. The second is the costs incurred to obtain that particular asset. If it's a large machine, you may have to have paid freight to get it to your particular plant, things of that nature. And last but not least is the cost associated with the setup. Typically, in a very complex piece of machinery, you would have installation costs. Okay, let's talk about depreciation calculations and what are the factors that affect the depreciation calculations. Well, first is cost. And basically with cost, we're talking about the cost that is put on the books, and that value of the asset that then is being used and depreciated. Secondly is the useful life. You buy an asset, it's going to have a likely useful life, just like a car. You may buy a new car today, but the reality of it is, depending upon the type of car you buy, it might have a useful life of 10 years. The third is a concept called salvage value. And that means what is the expected value of that asset at the end of its useful life. So, let's say you did buy a car for your business. Let's say you figured it had a 10-year useful life. You would probably go to CarMax and sell it. You would get some money back, probably not very much, but that would be the salvage value. And then the third factor is the depreciation method. And we're going to talk about the various types of depreciation methods. You're familiar with straight line depreciation. There is also something called units of production method of depreciation. And then there is also something called double declining balance method of depreciation. Okay, let's talk about the various methods of depreciation. And the first type, which is the one that you're most familiar with regards to plant, property, and equipment, is straight line. The second is units of production. So before we get into a discussion on depreciation, I do want to make one note. Typically, land is considered a long-term asset. However, land is not considered a depreciable asset. As you might expect, land would typically not depreciate over time. Therefore, according to generally accepted accounting practices or GAAP, that land would not be depreciated. However, plant and equipment typically would be appreciated. So let's talk about the various types of depreciation. First of all is straight line depreciation, and as you know, this is a very straightforward calculation. You take the cost of the item as defined in the previous slides, you subtract the salvage value, and you divide that by the useful life, typically number of years, and that will give you your annual depreciation expense. So again, get this in your notes. You take, for a straight line depreciation, you take the cost minus the salvage value divided by the useful life, usually defined in years, and that equals your annual depreciation expense. For units of production, it's a little more complicated, and here again, get this in your notes. You have the cost of the item, and here again you minus the salvage value. And as we talked about in the car calculation, you buy a new car for your business, it lasts 10 years, you drop it off at CarMax to sell it back, that would be the salvage value. So cost minus salvage value, again, divided by the useful life in units. So let's say you buy a machine and you know it's going to be able to produce 50,000 units over its life. Then you would basically identify how you would depreciate that by the number of units produced. So then to calculate your particular depreciation amount, you would take the depreciation rate, which again is defined as the cost minus salvage value divided over the useful life in units, times the annual usage. And let's say the annual usage is 10,000 units per year, and that would give you your annual depreciation expense. So make sure you've got those calculations in your notes. Okay, so the third method is something called the double declining balance. And in terms of the double declining balance, the calculation is you calculate the straight line depreciation rate, but you times it by 2. And that gives you your double declining balance rate. Then you take the double declining balance rate times the carrying value, and that gives you your actual depreciation expense. So here again, this particular method is used if a particular asset would depreciate at a faster rate, in the initial years of usage, as opposed to a straight line, approach. Okay, let's take an example. Let's say ABC company purchases equipment with a cost of $123,000 and pays $20,000 to install it. It gives you this particular piece of equipment has a 10-year useful life or 230,000 hours. At the end of the useful life, the equipment will have a salvage value of $5,000. So what's being asked here is that you determine the depreciation expense for the first 2 years using the various methods of depreciation: straight line, units of production, and the double declining balance. So in terms of your answer, you would look at the straight line calculation and use the particular formula we talked about for the year 1 and year 2. For units of production, you would take the rate, which essentially would be 60 cents per hour for year 1 and year 2. And then for the double declining balance, you take the rate times the 20% carrying value for year 1 and year 2. So let's pause here and let's take a shot at calculating each of these values. All right, so for a straight line, year 1 and year 2 would basically be the same because it is a straight line approach. Units of production rate, not quite the same. Year 1 would be at $9,000 and year 2 would be at $14,100. That's because you have various production rates in each of those years as stated in the problem. And the double declining balance, as you might expect, year 1 would have a much higher depreciation amount at $24,000. And year 2 would be at $19,200. Okay, guys, the one last thing that we'll close with, there are some different types of ways to value assets over time depending upon their usage, and one is called depletion. And this is typically used with natural resources, and it basically accounts for the cost of natural resources over time. And typically this is the method used as a unit of production method. Depletion again relates to things like oil wells, where you may have an expected production of a particular number of barrels that would be produced from the oil well. Let's say 1 million barrels over the life of a particular oil well, and so therefore you would use the units of production method. Amortization is typically the cost associated with intangible assets, and here again, these intangible assets could be things like a patent, which would have, you would have a patent that has a legal defined period where you can have patent protection. So you would typically use a straight line method. Let's say it's a 16-year patent. You would typically value the patent and then depreciate that over a 16-year time, if that's what the legal period where you would have a patent protection. There are some intangible assets like goodwill that you would not amortize because those would be more difficult to value, and goodwill is typically something that may not have a useful life associated with it. Alright guys, that concludes our last chapter of college accounting, and hey, it's been a great ride. Make sure you get your notes in your folder and have a great night.